Wunderschönen guten Morgen, meine Damen und Herren, und herzlich willkommen zum heutigen.
Yes, hello, ladies and gentlemen. Would like to welcome you to today's topic day, which we have called China at the turning point. And we are discussing the current context in the economic situation and what type of opportunities the investments offer these days. Of course, there is a problem with the COVID restrictions, but there also is a a political campaign going on in some of the sectors. The problems from the past have not disappeared completely, and the growth of 5% that was presented last week during the Congress is not particularly convincing either. So we are going to talk about where the borders are in terms of this economic growth, what has happened so far, have the prices on the market already considered these circumstances. We have three different perspectives that we can listen to today, and we have three speakers. You are familiar with this setup. We are going to start with Wolfgang Fickers from Congest. Mr. Fickers, welcome, and you can go right ahead. Yes, of course. So thank you very much for the presentation to present Congest today here about this really interesting topic. Most of you would know me. I'm Wolfgang Fickers. I'm the product specialist from Congest, and I'm joining you today from Paris. So then please start with slide 1. So that's the next slide. And what you see here is that if you don't have any growth in terms of profits, then you don't have any growth in terms of the actual titles. And of course, that is typical for investors in quality titles. And it's something that is relevant for the Chinese market. If you can see it, till you also seen when the regulatory bindings hit, and you can see that that really has affected the growth. It was well above average till that day. You can, of course, see China is green and the violet line is the normal market. And therefore, you can see that in the past, this was actually good development in terms of the equity market. And all the numbers here are given in euros. So since October 2020, when we had that financial IPO and the regulation sitting there, and of course, then the COVID problems that has affected this development. Then let's go on with the next slide. Thank you very much. So we have portrayed that here. What is the problem? Why did the benefits contract? You can see the factors here. I mean, I'm pretty sure you are familiar with all these factors, but from our point of view, there is reason for renewed optimism now, and we don't think we are looking at this naively. One thing that makes me positive in terms of China is that the growth motor has started again, and I think that is the actual crucial point. And why is that? Because the zero COVID policy has been abandoned, and that also means that the economy can start growing. That is the actual engine at the moment. After zero COVID stopped, we have looked quite closely at 40 of the titles, and that has shown us that the worst has passed. We've looked at different areas that are very interesting, for example, solar industry and pharmaceutical industry. And we know that there is growth to be expected. Then the real estate crisis has been under control since the Evergrande bankruptcy. We have new regulations for banks, and they are investing again in this sector. You know, this very restrictive credit guidelines did put some significant pressure on there in the past, but it's now under control. Then the negative antitrust law in the internet and the gaming, which affected Alibaba, Tinder and Co., and all these other type of companies, they are now behind us, and they have shown some growth, particularly in the last quarter, and also profits. Of course, there were losses. Some of the financial control had to be relinquished, but we think that the worst is behind us, particularly in the gaming industry. We see that there are now new approvals given, and so therefore we can see that is a positive sign. China, I already talked about battery technology, solar technology. These are interesting areas where China has something to offer. And then, of course, what's also important these days is that this growth package without inflation, they don't have the same type of interest spiral as in other countries. On the other hand, you have to be honest and say that China is a political market, will remain a political market, sometimes a highly political market. And it's difficult to say how the profits of equities will be valued. So how high will the risk premiums be for these Chinese equities? And that is, so we have a basic problem that's been solved, that's a profit growth, but on the other side, we have this particular question mark. It all started, for example, with TB because of data safety. This ADR listing was actually withdrawn. That was the Cyber Administration of China. Then the US Public Company Accounting did also ask additional questions because of accounting figures which were missing and data which was missing. And right at the end, then China finally actually opened up the books. And that is, I think, a very good example to take that the Chinese ADRs were really used as a paw in the political game in this US and Chinese tech war. And China is basically being not given access to the newest technologies or to the newest technology markets. And this is in order to decrease the dependency from Taiwan. And all of this together shows us that this tech war between the US and China is moving in this direction. Now let's move on with the next slide. Okay, so we have our own funds here, Comgest Growth China, that shows quite nicely how things are going. Of course, we have also suffered with that slower growth. And you can see that here in the dip in 2020. I think that is a good example that the regulatory restrictions started hitting there. The net asset value of our fund did go down by 18% and the profits by 11%. So we also suffered from this profit stagnation. Why are we now more optimistic for the fund for the next 5 years? We see an annualized 17% growth, profit growth. And if we do manage to achieve that, as we expect, then we think that this fund will perform really well. Let's move on to the next slide. Here you can see the development. So from the inception of the fund in 2001, and you can see that it's double from the comparison index, but you can also see in the last years how the gap has widened, unfortunately. And as I said, the reason for that is the stagnation. If so many tech equities are suffering under this new regulation, then for us as a growth fund, it is actually quite difficult to just balance that out with stock picking. Can we please move on to the next slide? Well, here we can see the numbers to show you why we are optimistic. If you look at the middle of our fund, though, with the relevant financial numbers, here you see that you see that we have earnings to growth ratio of 0.6, and I think that is really what you pay for every percentage of growth. The growth in Europe costs 3 times as much, and therefore we think that even given those high political risks, the growth potential on that market overall is still quite cheap overall. You can also see the 5-year EPS in the middle here, and if we manage to grow with the same double-digit growth as in the last years, then that will continue along those lines. You can also see net debt to equity, NTM minus 4.2%. And then you also see that reflected in the net cash position with a really good benefit of 14.8%. Can we please move on to the next slide? So you can see the top 10s on the left-hand side. You can see the heavyweights like Alibaba or Tencent or NetEase from the e-commerce and gaming area. As I mentioned before, they've shown significant growth in the last quarter. Alibaba, for example, 15% in the last quarter. And it's very attractively values. You see Anta, which is a competitor. And it also shows that there is a lot of domestic purchasing preferences. So where you don't have to buy products from abroad, the idea is to look more for domestic brands with Waigao or Vego, how it's written. It's one of the biggest medtech companies in China, so very solid companies from the different areas. Of course, consumption is also important. And on the right-hand side, you see some of the new growth engines. So there's a lot of investment in health in China. That's not just the government, it's the actual population who is happy to spend a lot of money on that. So Mindray is a good example. They produce diagnostic devices. You can compare it to the Japanese Sysmex or the German Siemens. So they are both big growth companies. Then decarbonization, Li Auto is a holding in our portfolio. It's one of the profitable electric manufacturers of electric cars, because they have focused on one car and they produce it with high total margins, which are way above the average in the industry. Or if you go into the services area at the bottom, there's good service companies available. CTI is one example. It's similar to the German auto control institution, and is a good example that there are really different growth industry within that market. And let's just move on to the next slide before I come to my final remarks. So you can see on the right-hand side the growth story in the medium sector in China. This is something that we really focus and has always been the focus of the fund. Then we show you the red area, which is the health sector. So with 11%, we also have Ruxi Biologics that I already mentioned before. They actually have the Swiss company Loncha as their competitor. And they're very specialized companies with high margins. And then we also have the big internet companies out like Tencent and Alibaba. And then we also got quite specific industry leaders. So technical services, CTI, for example, that I already mentioned, that are represented in the portfolio with 13%. So all of these are companies that I would like to call as having very distinct modes. So they are companies who offer something that's very clear and tangible. They are commodity companies, and their growth engine has already started to run, and they are coming out of the COVID crisis with good speed, and that's what makes it optimistic. So my final remarks, so that would be the next slide. I think I pretty much covered all of it. So of course, yes, the lack of profit, the zero COVID policy did affect the Chinese market and did really affect the growth story on that market. And the same goes in terms of the return on equity that was affected by that. And if we leave geopolitical developments aside, domestic developments are looking very promising. The growth story is something that we think will continue. We see higher industry automation, electrical mobility, battery technology, and solar industry, and they offer growth potential for the future. And that's all from me. Thank you very much. Then I'd like to welcome Mr. Mirko Wormuth, funds manager from the Capital Leaders Fund. Okay, let's see what happens. I'm trying to share this. Can you hear me good? Yes, excellent. Okay, then thank you very much, Mr. Bartels, for the invitation, and also to Mr. Fickos, because I like this macroeconomic perspective, which I can now basically use, and I can directly concentrate on some more concrete topics, what has happened in recent times, and also how that has affected our fund, and give some concrete example. So what we have seen was a very good rally that basically did start after the party congress in October. It was a bit unexpected, and it was because there was this abandonment of the zero COVID policy. So in January, development continued.
Ich habe 23 Jahre in China gelebt, bin von Hause aus Anwalt, aber die meiste Zeit in China.
I'm losing sound here, so sorry. Coming back on board as soon as I can. Okay, so we do have growth potential, and that also depends because
I speak fluently Chinese. So I'm very close to the country. I'm very close
some Chinese, and I read a lot of literature.
Is going on. I'm talking every morning.
That is why I always can.
If I can't be there
familiarize
directly,
myself
I'm in
with the
touch all the
developments
time.
there. So what we're having at the moment is now about from our house, the Digital Leaders Fund, Pi for Capitals. We have the Digital Leaders Fund. I'm in charge of China Digital Leaders, the third baby here, and we are specializing in digital and tech equities from China. It doesn't matter whether it's E-share or Hong Kong shares or EDRs in the US. What we've just seen is basically the same pictures of the 20th Party Congress. These are the new bosses. And what you need to know is that, okay, I lost sound again. Sure.
So if we are comparing to the last Congress, that was a speech that was somewhat encouraging. That was not so much, let's say, really aiming at geopolitical tension and the Taiwan issue. So how is it going with the private companies? What is the expectation? Xi Jinping himself has been speaking to that topic, and that was, of course, very warmly received. And we can, of course, now looking at reports to see what can we see here independently of Jinping or dependently even of him, what can be done. And so I'd say there's a lot of expectations, which is something, of course, we're all very aware of. But I don't think that certain times have passed and we're not going to see the same again. We know now who's the strong man in the country, obviously, but we also don't see anymore is that these kind of platform companies, they're just no longer in the National Congress or in the other committees. And that's something that been seen in the last few months. These are other companies that are sitting in these committees. And I'm mentioning this here because these are things that are very important when you're looking at the landscape of the companies to see who will benefit from this new direction of Xi Jinping. Here, for example, that's like RTL, it's like a huge, that's someone who was sitting there now, and Lu Xingfeng, for instance, it's Lifeline Tech. That is a company with language processing and in the artificial intelligence area, very, very active. And so these are new personalities that we're seeing in these committees, and that's a way that can show us where the journey in China is going. And then we're, of course, looking at the opportunities. China's internet is, of course, something, and we've already heard about it. And we've already had a certain rally, I'd say, and it'd be good to take a look at where's Alibaba at now under these new circumstances. And that's, of course, something that we want to see reflected in our portfolio. And that's something that we've just heard already from Wolfgang Feikes, and maybe we'll be talking about this a little bit more, how we have certain areas in the portfolio that we need to take really seriously. Just as an example, something, for instance, in the big baseball events in the US, or the football event, actually, for the Super Bowl, for instance. So if people are saying, well, having these commercials, they're saying, well, what is this, Tim? Well, this is for an e-commerce platform, and from Pindo is the driver behind this. And so they are coming into the international market, as we have from Southeast Asia, for instance. And some, it didn't work quite as well, but they started in Thailand or stopped again in Thailand. But this is a trend that we are seeing, and especially since the growth in China has been somewhat slowed. So this is something that can happen now, and that is becoming very successful. Another example that we've also already seen and that we've also mentioned is a digital education company in China, Zifengi, and you see that FB up here on the top. FB, that actually means chalk in English, and that's from a education startup in China, which actually suffered very strongly, very badly under the new regulations. So again, something that we've mentioned earlier in 2021, we've seen the double burden of the regulations, and almost all education technologies had to deal with the new curriculum in the school, and so then they somewhat died off. So it was a new orientation, a reorientation that took place, and certain companies just disappeared. But what's really exciting now, and that we've had an IPO that happened, I think, on January 9th with this SP, and that was something with based on the new regulations. It was able to see, well, where does the state actually want to go in terms of education and education technology? Where does it want to invest, and where are we building the sector out? So this kind of specialization is an assessment of for teachers, and all these exam preparations or this assessment, which instead of having the offline players, we're having the digital players now, who have really shown an extreme development. It's extremely popular in China. And like I said, they had the IPO just recently. And so it, of course, helped the company to have that kind of success in this ecosystem, and to really get into that market. So we can see that right here on this chart, and it's really what we've already seen in the beginning has been continuing. So that's a value that really evolved beautifully. Something else that I want to talk a little bit more about, the whole ecosystem of electric cars, of course. This company is called Sai, and Hisai. And again, that has also had a new IPO, big investors that stepped in, and they really are focusing on everything that's electric vehicle, automatic systems, and everything that's, of course, needed for automatic driving, for self-driving cars. And we had, like, I think 26% autonomous driving, and even over 60% where this technology is needed. And so they are creating this technology with this basic technology, with the integrated circuits that will be used in these cars. And so and there's 10% of the costs can be so it's very cost effective. They have their own manufacturing. And as we all know, of course, in China, they have, of course, the biggest electric vehicle market that exists. They have in China, those are not only electric vehicles, there's also these new energy vehicles, and that also includes the plug-in hybrids, of course. But still, this is a huge market, and the company has had a very positive stance here, and has really accomplished a lot, and more than the 8 successor companies. And so that's, of course, something that we're observing with great interest, to see how we're having a market of 3 billion, and in the next 5 years, we're seeing some millions of growth in the sector. And for all the other Chinese companies that are going to step in, and that are going to also be equipped with this kind of technology. And we're expecting this to increase to 84% over the next few years. So that's really, really exciting from our point of view. And that's, as we had mentioned earlier, the ADR deal listings, something that we've already, the IPO, and this company had actually an IPO in the US in February. So that's really beautiful to see what the Chinese companies doing there. And I'd really like to point that out again, that of course, when we're dealing with certain companies and with the public companies, where are they going, and what are they, what kind of release do we hear from them, and what are Chinese companies like? In December, we saw that officially there is no delisting risk any longer. And so here we can see that there was actually not enough reporting on that. But if you look a little closer, we can see that this is no longer an issue. And that's, of course, something that we have to take into consideration, that the Chinese are really right here at the table. And at least for the private companies, listing is no longer an issue. And so, of course, in a timely fashion, they just got in with their own companies, because they would not, of course, have the trade secrets revealed. So they did take them out. So now there's really space for the foreign companies to step in and to implement that. And so I'd say that's one headache less that we have to deal with. So that was it from my part. I'm very happy to answer your questions later. Excellent. Thank you so much. That's really interesting. I hope that after the next presentation, we'll have a little bit of time for discussion. We have Giorgio Carlino from Mediolanum, and welcome. You may start.
Hello. I hope you can hear me well. Ich kann nicht die Präsentation auf Deutsch machen. Entschuldigung, mein Deutsch ist nicht good genug. So I will go with English. So my name is Giorgio Carlino. I'm the head of multi-management here at Mediolanum. Mediolanum International Fund is a boutique, I would say, asset management. We manage 50 billion, and we manage mainly in multi-management. So what we do, of course, we select the best manager in the various region asset classes, trying to combine them to deliver a superior performance. As I said, I'm Giorgio Carlino, 23 years of experience. I work in Italy, in Germany for 5 years. Ich war in Frankfurt. Ich arbeite für Allianz Global Investor. And then I went to New York for 7 years, and then the last year I've been with Mediolanum. So China, I would say we can start from the why China. So in the first slide of the presentation, we can see it's pretty straightforward argument, right? So China is growing at an amazing pace. Is already the second biggest economy in the world, and attract a lot of talent and opportunity. So we know it's very big and growing, and we can see in the following slide, the question is when it's going to take over and be the biggest economy in the world. So if the path stay as is in the last few years, you see in the slide 3 that China will overtake US in 2032. Of course, we have to, put a big parenthesis or caveat to that, because the assumption is that the path continues as it was in the last few years, and is not always the case. I mean, hiccup, we've seen it, everyone within the COVID, the reaction to COVID, the restriction that China had, and now finally reopening, probably brought China a little back in this trajectory, but the story is still the same. It's still relevant. So China is growing faster than anyone else, and is an opportunity that we cannot overlook. And in the following slide, we also see how and what are the driving forces of this growth. Right? So it's attracting a lot of capital. The transportation and urbanization of the China is growing really fast, building infrastructure, the new Silk Road story, so how China is going to integrate itself with Asia and help other countries also to develop the consumption evolution and the growth. So the technology, the digitalization, we know, China is highly digitalized and it keeps moving in that direction. It was a bit surprise for me was to see how they're also leading in the college degree. So the number of degree, it's growing really faster. And a lot of universities in China are now well respected at the global level. So the China is growing, and there are a lot of factors that are driving this economy. It's not, as we know, probably been already said by the other presenter, that the exporting, being only an exporter story is not the only one anymore. It's actually a way rounder story for China in terms of growth and potential investment potential. So we said that is growing faster. The GDP is catching up with the GDP, the global development. The GDP of US is catching up, and we see in the following slide that yes, it's true. GDP is catching up, so the size of China is not too far from the size of US. What is not true, though, is the representation of China within the investment world. So within MCI all country world, so the one that include also emerging market, China represent only the 3.5% versus, again, a fifth of the total GDP represented in the financial market as an investment opportunity. It's way smaller. It's reasonable to assume that this will change in the next few years. Of course, there is a lot of let's say, issues that goes with China. We cannot forget that it's still a centralized economy. So we'll have to, wait and see to really understand which pace the adjustment is going to happen. But it is there. And again, the normal assumption is that that gap will be filled by the amount of investment. So the opportunity is big and it's still there. It's not already gone. So it's still an exciting opportunity where we can see investing and investment keep moving towards China. Of course, it comes at a cost, right? And we see in the following slide, we said China is always in the news. Every day is in the news, every day for a different reason. Can be very positive, can be very negative, can be the impact on inflation globally for the reopening, because China reopening, of course, will imply a lot of more demand from China. A lot of demand from China imply price going up. So it is an inflationary movement. But it's also on the news when we talk about Taiwan and the geopolitical situation, the news about the growth, the relation with Japan, the relation with US, the relation with Russia. And actually, this morning was the latest announcement that Xi Jinping, it seems he wants to play a major role in discussing the situation between Russia and Ukraine. So it is always in the news. It's a lot of noise around that in the short term. But we have the story of the long term still intact. So we should not get distracted too much about the single news, because in the long term, we expect China to grow and to grow significantly. Of course, when we do investment, we need to take into consideration all the risk, and the risk is there, right? China, as I said, is a centralized economy. The last Xi Jinping took the third mandate as absolutely an exception. Never happened in the last 40, 50 years that the same president stay in charge for so long. So that, of course, is a bit of a risk. And what US is doing in terms of limiting access to the technology and the new technology, the most relevant technology, to China and vice versa. So we have the risk that world could move into let's say, the globalized world when we have two areas, the one around US, the one around China. But even if that was probably the worst case scenario, even in that case, China remained an attractive investment opportunity because the growth in China will be there regardless of the, let's say, geopolitical tension. As I said, investing in China is a risk. China market is highly volatile, and we know the volatility means I can see my portfolio changing significantly from +20 to -20. Volatility of the China is around 30%. That means that 2 standard deviation. So what is reasonable expectation? Like 90% of the case, we are in a range of +60, -60. So if in 1 year the China index would lose 60%, we should not be surprised. If it does +60%, we should not be surprised as well. So it's highly volatile, but with a positive inclination, right? It's growing in the long run, but with a lot of dispersion around the time. And we see that in the following slide, where we plot together the monthly performance or the monthly variation. Actually, sorry, yeah. There's a monthly variation of the 2 major indices. Actually, we took the iShares, or the ETF, just to look at the volatility, and the MCI China A share. So for the A share are the share class that are available only to the Chinese investor and some, let's say, to the local market. And the B share are the one open to international community. So you see both indices are highly volatile. We see movement in this monthly movement of more than 20%, both positive and negative. So once again, we should not be surprised from having this portfolio moving a lot. But there are a few ways to kind of, control a little bit for that. The way we decide to go, and you can see in slide 8 with our Mediolanum Chinese road opportunity. We want to take advantage of the capital growth of the Chinese market. So we want exposure to this market. But the best way for us to go was to go and look for the best manager in that asset class, and also for the niche manager, so the real expert in Chinese market. You see the combination of the manager we put together in this portfolio. We have 4 main managers: Schroeder and Goldman Sachs, big names, big houses, a lot of presence in the area, analyst, portfolio manager, risk management. That's the top, let's say, of the asset management distribution force. So we put these 2 big names together that give us the solidity of the portfolio and the confidence that they know very well how to select stocks, but also want to combine 2 niche managers. In this case, Binyuan Capital and 91. They are really specific with that for their market. So they know the mid-size, the small-size stocks better because they actually live there, touch it, breathe it. So the local presence is an advantage that I think in some markets, and still China is one of those, clearly is an advantage. And that's why we want to combine these 4 managers to take the best of each of them and combine in a way that can deliver a better result in the long run. So building this portfolio this way clearly gives you an extra diversification layer that is not just, the 30, 50, 100 stocks that you can have, but also different way of approaching a specific asset class. In this case, you have a number of stocks, but also 4 different managers. They have different insight, different view of the world, different way of putting portfolio together. So let's say it's it's diversification at the exponential level. So it's the square at the square level of diversification. But even doing that, you can see in the next slide, volatility is still there. So I like to talk about volatility a lot because we want to make sure that our investors are fully comfortable with the position they take, and so they size the position of China in a correct way for their client. So even doing this combination of different managers, different shares, you see how the up and down are still pretty significant. So we have movement of +15 and -10. So when we accept the fact that that can happen and that will happen, then investing in China, it's absolutely a great opportunity to take advantage of the story and the opportunity of the investment and the investment that is there. And in my last slide, so then we can have open for Q&A, it's just a summary. Again, it's a short-term noise, so there is a lot of noise, but it's a long-term opportunity. It's still there. It was there 3 years ago. It's going to be there for the next probably decades. It's important to have exposure to the local market. So in this case, the China A share, then in our case, represent more than 20% of the portfolio. And it's important that you actually put together managers that have really the local insight, spend the time there on the market, understanding the shares and the political system and everything that is connected to that in a way that would be very difficult for, let's say, an Italian like me go and invest in China. Doesn't mean, of course, that it's not possible, but we think that combining them is the best way to achieve the result in the long term. Thank you.
Ja, vielen Dank, Herr Carlino, für den
Thank you very
Interess.
much, Mr. Carlino, for your interesting talk. So now we'll take another 10 minutes to answer your questions, ladies and gentlemen. So use the chat tool and please ask your questions. If the speakers could please leave their cameras on. Mr. Ficus, you had a slide which talked about China's headache and the zero COVID policy. And of course, now a lot of investors are hoping that finally China's engine is up and running again. However, the political situation in China is still considered as unstable. So what do you think? Do you think that people underestimate the geopolitical risk, or do you think, well, it's already all been priced in, it can only get better? No. So I think who invests in equities, and that's not only true for the Chinese market, but also for many other countries, or for example, the banking sector, where we already said that 3 days ago, you need to be realistic. However, the movement that we've seen at the beginning of the year and then we've kind of like seen some contradictory movement because the equity markets did shoot up so quickly that at some point the only realistic thing to happen was movement in the opposite direction. So when you have a 0.6 valuation, and then in other markets you have something ×2, then the quality of the growth that you can see in China, obviously that is reflected in the risk premium. And, you know, that's positive, but it also doesn't mean that you definitely need to jump into the Chinese market. And that's just very easily because the Chinese state, to some certain extent, is unpredictable. And I mean, we've talked about the portfolio construction in China always has to be measured against this political background. You're trying to avoid confronting the Chinese state. But the question, of course, is whether you always manage to do that. I mean, Xi Jinping already said or showed on the Congress who is the boss. And he basically showed very clearly he runs the show and the work has been done. And basically, now we've seen, for example, with some of the internet platforms like Alibaba and other internet platforms, that they were not so accepted. But what we see is that the domestic risk has now reduced. So the whole environment is a bit more friendly. And we think that for the next 5 to 10 to even up to 20 years, the question is how the Chinese will get along with the Americans. And that's still a relationship that is very complicated and full of conflict. But the bottom line from our perspective is that if we're looking at the domestic potential, we looked at the companies, 40 companies in many different sectors in our portfolios. The macro data look good, but we are micro investor. We also want to look at the micro data, and looking at those fundamental data, I would say that now we have against this wind at our back, and we don't have the interest rate scenario like we have in the US, in Europe, but there is this one risk, which is this trade tech war between the US and China, and that can flare up time and time again. So we are cautiously optimistic. So Mr. Womit, I mean, we just heard from the macro data, but on the Congress, the Chinese government did set themselves a moderate growth target of 5%. And the question would be, what the development that we've seen since February, that's basically stagnated a bit. What's going to happen with that? What can we expect over the next quarters and the next years from China? Well, that is a good question, Mr. Bartels. We see those 5% and says, well, you know, that's nothing big. I mean, if you look at the global context, then of course it's pretty dapper, but we know it's quite a low base from which we started last year, and that most of the analysts assume that they are going to be able to achieve that. I mean, last year, of course, there was a different scenario with a lot of forced and unforced areas where they didn't really achieve what they want to set out to this. So the question is, the 5% this year, how are they distributed, and how are the individual provinces actually going about reaching this target? And then I think we are all in agreement that it will go above this 5%. However, at the same time, you have to actually look a bit more in detail at those 5% and ask yourself what it means. And what we can see is that it's not a completely crazy infrastructure stimulus, which we are expecting now. So what we read out of this 5% is that they want to achieve qualitative growth. And that means that we're not building bridges into nowhere, and we are building, I don't know how many extra highways, but we are actually now looking at GDP, qualitative growth, measures that sustain that. And that on the other side, we don't forget what has happened in the last 6 to 9 months. So the stimulus which have already flown into the market, the money that's already there on the market. And if we are being really honest, the biggest problem, and many observers note that, is that China, measured against the GDP, is still has a very, very slow domestic demand. So if you look at that, and that has been mentioned, and for example, that's also down to the real estate development. I mean, 70% of an individual's net worth actually goes into your real estate. And if you don't really know what's the value of that real estate and how much money you actually have as a family, then it's really difficult setting some money aside to buy something else. And that's the problem, that the Chinese haven't found a way to move away from this supply side reform measures and to move to demand side reform measures. So the massive investments that would be needed in terms of health insurance, social insurance, national insurance, and so on, a kind of wealth transfer, moving away from local governments to the private wealth, that the private consumers have the feeling that they have a safe future, and that they don't have to keep saving, because otherwise we'll just stay where we are. I mean, we looked at this 18 billion, which we're still sitting there on the private accounts, and that's the problem still. Mr. Carlino. So Mr. Wermuth just mentioned that now, so the real estate crisis didn't only affect China, but the whole world. the drama about Evergrande did seem actually quite threatening at some points. So what does the real estate market look like in China? Do you think it's a global threat, or do you think that now finally a corner has been turned?
That's a difficult question. We don't know if they already in a situation that problem is under control. We do know, though, that they control the economy. And in this control, they are really aware of the risk, posed by the valuation of the real estate. So they will do everything in their control to make sure that this valuation stay as stable as possible, and where there is a bubble, they can pop the bubble and control the outcome. So I think it's very important that they're trying to switch from an external driven economy to a demand-driven economy. And if we look at their track record, it's quite outstanding. So they know the problem, and they usually figure it out a good solution. And they bring more and more people to do what they need to do to grow the economy. So to me, an important question that I was posing myself to consider an investment in China is like, if worst case scenario, the two economy goes different way, can China be a good investment without the rest of the world? And as today, of course, the question mark is quite big, but I'm convinced that they're fully aware of the problem and they are already moving in that direction. And just to finish, like clearly there is a lot of excitement about China still there. Just looking at our fund, we launched it 3 years ago, and we collect already 1.6 billion. So there is a high attention to the market, and high confidence that they can deliver.
Herr Wormuth, was könnte denn dem Wirtschaftswachstum in China in den nächsten Monaten?
So, Mr. Wormuth, what could affect the Chinese growth in the future? Where do you think the limits are of this economic growth potential and this positive development that we've seen in the 5 or 10 years? Or aren't there any other maybe emerging markets that are interesting? Do you think that China has maybe already passed its peak? Well, I of course have to say no, of course not. But I see the growth potential. I see the strengths. Maybe I don't see what Carlino has mentioned, that there is still this risk of the tech war between the Chinese and the Americans. However, we do see big risks in China. Might be demographic risks, which can be quite a bellyache for the government. And that's just the aging of the population. But that's not a problem that's unique for China. We see that in parallel in other countries. That might be Japan, it might be South Korea, that might even be Germany. So these are problems that we see in all the countries. If we actually look at the systemic problems that's really specific to China, then I think, if I have to be very critical, what I would say is, and what I would ask myself is, how does China make it possible with its new economic growth policy to achieve the same success that it's seen in the last 20 years with companies like Alibaba? So they have these very well-known, very influential founders, which basically were pushing along this development. So who is the next generation that's coming along? I tried to basically look at who is in the pipeline at the moment and who's got this innovative power that China also needs, specifically if we're looking at this demographic development, so to support the productivity of the country. And if we look at that from a geographical perspective, China is very close to Southeast Asia, another strong area in this world geography. And I think these are countries which will build strong relationships. And if we look at the trade between China and Southeast Asia, yes, of course, China in terms of growth, in terms of the market growth, and that's the same if we're looking back at Germany and the medium-sized companies, how they're still a growth model. Yes, these companies will remain in China and produce for China. And from a political perspective, that might be questionable for many. However, for the market, that is just a natural development, and it's very fascinating. And that short-term noise that also mentioned, Mr. Carlino said, he said short-term noise and long-term opportunity. I found that really interesting. It's not only short-term noise, there also will be long-term noise, but who understands China and who looks at the opportunities and can identify them, these type of people will also have the long-term opportunities. Okay, I think this afternoon maybe we can talk about this. Mr. Fickes, one final question to you, because you've got quite a broad product offering. You've got there is other countries who appear attractive, for example, India. So should one say, look, let's leave China to one side. Let's look at India or another country, or is China for you still the one and only opportunity? Okay, China is part in our emerging country funds, and it's still the heavyweight in there and also in the Asia Fund. That's because their capital market is very broad and there's so many companies present there. If I'm looking at the relative positioning, which is basically the result of our own thinking, then we, for example, are very heavyweight in Brazil, where we find excellent companies, and where also the currency is beneficial to us just because of the exchange rate development. And compared to the benchmark, I wouldn't say there's such a massive overweight. I mean, maybe 2 to 3% in China. I think the much more interesting question is what happens with the global equity market and the emerging country or emerging market fund. If we're looking at China, the IPO for the Ant Financial, that then didn't go ahead. And this regulatory problem, you know, but we've actually then just withdrew really quickly because we saw that the risk was too big for us, and we're looking for less volatility. And if we see the political risk is there really, really high, and there's also market risk premium associated with that. And if we do work in these markets, then I think we cannot only go by these lower valuations. Of course, that was a movement downwards, but I think what you just have to do is be careful in your positioning. And it has become also clear that a lot of these problems don't disappear overnight, but they are moving in the right correction. And like Mr. Wormuth said, that the Chinese consumption is also, of course, it depends on that, particularly the real estate problem. And then also the domestic political situation we see is a bit more stable now. And we've seen that with many problems, the EDA question also is also something that I mentioned that seems to be okay. Seems to be a really friendly environment at the moment. I mean, it was very difficult for the last couple of years between the Chinese government and the US, and we don't, we see a lot of overhang that's disappearing. And the one thing that we still see, and that's the always been like this in the history of economics, if you've got massive power that's being attacked by another big power. So, you know, Japan at some point, Chinese these days, that's always a time that comes with many question marks. And you see that also with the investment that happens in the US. There's not as many investments going into that countries. So basically the money that's being invested in Asia is not as much as before. So it is an equation which is looking a bit more balanced, but we still have this political question mark hanging over it, US, China. And I mean, that's not going to improve. The stronger China becomes, and we've heard that there's many markets where China becomes more dominant, and then this conflict just becomes more prevalent as well. And that's the big question mark from our point of view.
Auch heute Nachmittag noch fleißig weiter diskutieren.
Very exciting, and we keep talking and discussing this afternoon. And then, but for now, I'm going to conclude our round, and I have one question for all three of you. How would you say as China fitting into a diversified portfolio? What kind of weight has that changed over the last months or years? And could we actually really just let go of China? Mr. Wermuth, can you start? Well, I didn't get a chance to think about it, but okay. Let's see. I would say that really has to do with how risk averse or not risk averse you are, so how risk happy, and that's something when we're looking at the global numbers. China would say right now is clearly it is underweighted, it is underrepresented, and there are of course a lot of people who are thinking, oh, they're not getting on the train fast enough, and I think we could see that really well in January. And there's more happened than in the entire year 2020. And so when we're looking at these numbers, that's really something that we can do a lot with. There are a lot of hedge funds and fast money that was happening there that you could benefit from. But the question, of course, I just briefly would say, I'd say just a certain percentage needs to just be in there. Mr. Figgis, what used to say? Well, we're no... I would say you should have a proper strategy, but the world economy really is driven not just by China and the US. I would say in both countries, you need to have investments, and not saying one is not investable or saying I'm only putting my money into the US. That is not quite the right strategy, I'd say. I think you really do need to diversify, and you do need to invest in both those giants, and you know, that makes part, that's part of it. Mr. Carlino, you are up last. Please, the final word.
I would say probably in line with what they just said. So I would put numbers between actually 0 and 20, right? At 0 is where you like have zero trust in the political situation there, but clearly you're overlooking an opportunity. So in 20 is the max you can have because of the risk that asset class bring to your portfolio. And I'm thinking, an equity portfolio only. So it has to be limited because it's very, very volatile. But probably more important than the weight you want to have, how you get exposure to it and in the timeline. So my recommendation would be pretty much for every asset class that is so volatile to enter, like let's say in the next 18 months, every 2 months you get an exposure. You keep growing exposure to get to the exposure you want to have, because the opportunity is there, but it's not going to be, there's no risk to miss it because it's a long-term opportunity. And meanwhile, you can, mediate and have a better entry going to the market, taking the assumption that we don't know what the market is going in the next 12 months. And so the best way is always mitigate with averaging it out, the entry point.
Der sogenannte Cost-Average-Effekt nutzen, Sparplan abschließen, genau. So sieht es aus. Vielen Dank, Herr
So of course,
dass Sie sich
that's an excellent point of view, and I would like to thank you all so much for being here, Mr. Carlino, Mr. Figgis, and Mr. Wermuth.